and welcome. My name is Rashim Moga and I'm your host for this Empowered Women of the World podcast, a podcast where we talk about technology, leadership, and success. If you have been following the job market, you know that there is a lot happening in the startup world. I've had people in my network reach out to me to understand the PE landscape, the private equity landscape. So I thought, instead of me providing this information to you, why not bring a leader who has experienced it all in the PE world? So today, I am excited to have Kate Winkler on our podcast. Kate is a technology entrepreneur, mid-market business advisor, and she has helped over 75 companies to build and capture over $4 billion in enterprise value. Kate, I'm so excited to have you today.
Oh, thank you so much, Rashim. I'm so excited to be here.
So Kate, you and I met on a speaker panel a couple of years back, and since then we have collaborated on quite a few initiatives. You were one of our speakers at the eWOW summit as well.
I was.
So you recently left your CEO position at Ruby to pursue your giving back journey.
Yes.
And I'm in awe of what you and your team achieved at Ruby. I think the audience will benefit from learning about your career and your journey. Why don't we start there?
I'll try and keep it as short as possible. I get this question a lot because everyone says, I want to be a CEO one day, and how do I become a CEO? Well, let me start with, I never thought I'd be a CEO. I graduated from college with a business degree, and I started my career in public accounting. And I learned pretty quickly I didn't really like accounting. It was honestly a little too stagnant and factual for what the things were that interested me. But it was amazing training because you got to see how many different types of businesses work. So it was almost like a business 101 degree. And my clients were anywhere from large pharma companies like Abbott Labs to international ad agencies like Leo Burnett to even small businesses. And it was here where I found my love and my passion, which was technology. So I was actually recruited from one of my clients, which was a fast-growing technology company that was building the first-generation websites for United Airlines, McDonald's, Kellogg's, Maytag, all of these big brands. And they hired me as their 24-year-old CFO. And here's the funny thing. I was absolutely not qualified for that job. But the funny thing, nobody was. And technology was something that was so new, and it was changing daily. And we were creating new business models, and we were creating new products constantly. And so there really wasn't a resume of experience that said, this is what it looks like to be a CFO in technology. Mm-hmm. So I set my desire and my passion on an industry versus a career versus a role. And so over the next few years, I held just about every single job you could have in a technology company. So not only was I the CFO, but I also ran business development. I built a product from scratch, which included not only designing and writing the product, but building the pricing model, the go-to-market model, and even launching the product into market. And so by the time I was 30, I took all that experience and I said, I really want to go work for a private equity-backed business. Not really knowing what that was, but kind of being like, ooh, these are the high-growth businesses that are getting all the money. I want to go work there. And so I was hired as a CFO of a high-growth messaging and alerting business, and I was asked in my first board meeting, so I was about maybe 60 days in, hey, when are we going to ever be profitable? And I had spent the last 60 days looking at the business, looking at the technology, looking at the go-to-market model. And I looked at everyone in the room and said, you won't ever be profitable. And the looks on everyone's face like, what do you mean? And then I sat there in this room and told all of these folks that were easily twice my age, your model's not scalable because you're deploying custom solutions. And your pricing looks like a services business with low gross margins, and you're not going to get any scale advantages from all of this amazing technology that you built. And what you really need to do is go build a common back end, because technology is actually something will drive efficiency of scale if you can get to a commonality on the back end. And really what you're doing is configuration and not customization. So unexpectedly, I became the CEO the next day, and I was already unprepared for the CFO role, and now I found myself as the CEO at age 30 of a private equity-backed company. But the wonderful thing about technology, the wonderful thing about private equity-backed businesses is they're actually designed to embrace change. And so fast forward, I've not only now run Ruby, which was one of the companies, but I've now run 3 high-growth private equity businesses, and all 3 were sold to strategic acquirers. And in the middle of those little 3 stints as a CEO of technology companies, I also spent 9 years in technology investment banking. And what was actually really intriguing about that is I got to actually work with technology CEOs to help them grow their businesses, to help get them the financing that they needed to grow their businesses, to get the right people, to get the right processes and systems in place so that they too could really take advantage of private equity.
And by the way, I love that journey. I totally love that journey because it's all about things that resonate with me, being selfish over here, but taking risks, saying yes when you're not prepared. But I think what you did in that journey was also, as you described it for our audience, you shattered a self-limiting belief for audience across 60 countries who is listening to this, is the fact that you have to be a technologist. You have to be an engineering major. You have to be a developer. You have to know so much about technology and be an expert in technology to be able to lead a technology business, which is not true at all.
It's not. In fact, I've never written a line of code. And so while I've built product, I was the product manager and the designer and said, could we build, here's the idea, here's the problem that we're solving for the world, and can we build it, design it, and actually create a market for it? And so it's interesting that you say that because yes, I have never written code and it's so foreign to me.
There's so many founders and CEOs that I talk to, Kate, who have this brilliant idea that requires technology, and they're so nervous about the fact that they don't know technology. And that's why I wanted to call it out. So PE 101, demystify private equity for our audience.
This is a fun question, and I appreciate you asking that because private equity has a almost intimidating persona to it.
Yes.
And the reality is private equity is just an investment in a private business. So it just means that if you're a business that's not traded on the New York Stock Exchange or the NASDAQ and you don't have private capital or your own personal capital to grow your business, there is a market called private equity that can help you grow your business without being a public company or without having to take on things like personal debt. And private equity is an amazing source of capital for small businesses. And if you think about how private equity works, it's actually led by an investment manager. So an investment manager goes out and raises money, puts money into a fund, and they typically go to pension funds and wealthy individuals and collect all this money into a fund. But investment managers have very specific criteria for how they actually invest that money. So some funds might focus on something like technology or even something like green energy as an example. And investment managers can also invest in multiple different companies, but they also set very strict criteria that limit some of the things that they do, because you don't really want to have your investment manager investing in a competitor because now there's a conflict of interest. Or it might limit the percentage of a fund that they can invest into a single company to reduce fund risk. And of course, just like any investment, the goal of the investment manager of that fund is to grow the business so that the end result is they get a return on investment for the investors that contributed money into that fund. But here's kind of the math that I think a lot of folks don't understand. There is a target return for a typical private equity fund, and that is usually 3 times the initial capital. So if you say, my initial capital was $50 million. They want a return of 3 times that, so $150 million, but then you have to add the initial vested capital. So it's really, if you think about the math, you multiply by 4. So if I raise $50 million, my return, my valuation at the end of the day needs to be $200 million. But
and of that $200 million, because this is something I think people need to understand, right? This is your journal partner. This is your investing partner that's expecting you to be able, as a founder, as a co-founder, to be able to make some money out of it. That return has to be even higher than that.
Correct. Well, and it kind of depends. This is where things like structure come in. So if you create a pool where every investor is treated equally, so everyone has common shares and you only sell for $50 million, 30% of your business, then you're actually, that $200 million, you all get your pro rata share of that $200 million. But very often, depending on the stage of your investment, what will happen is an investor will come in and say, well, my equity is more preferred or in preference to your equity. So you have to actually give a minimum return, usually that 3 times return to your investor before you get paid as a founder. So these are some of the dynamics that you really have to make sure, the type of equity. And I tell founders all the time, just because someone's willing to give you the biggest valuation doesn't mean that that's the right investor. Because if it's preferred equity with an accreting dividend every year, and it has a 2x, liquidating preference and all of these things, now all of a sudden you're so far down the line. And so even though maybe you only gave up 20% of your company versus 30, you're last in line to be paid in the event that there is maybe an outcome that isn't 3 times that you're not excited about. Whereas if you're common and everyone is treated the same as an investor, then you have an opportunity where you're going to get your 70% out at the exact same time your investor gets their 30% out. But to complicate it even further, a fund has a defined life. And so a typical fund life is 10 years. And most funds actually have rules in them that say, well, for the first 5 years of a fund, so you'll see any fund will say, we have a $750 million fund, and it's a 10-year life. Well, for the first 5 years, their job is to invest all of that money. So they're not necessarily seeking exits in that first 5 years, but they have to deploy all of that $750 million because investors want that capital working for them so they can get a return on investment. And so what they're doing is their investments are there to support that growth and scale. But the second 5 years are there for optimizing the investments and seeking liquidity, so which is a fancy word for selling the business to a new owner. And so while a typical fund has a 10-year life, the average hold period for an investment is actually only 3 to 5 years. So what ends up happening if you're a founder that takes on private equity money for the first time is really the first 1 to 2 years are invest. And really about the end of year 2, starting in year 3, you're going to see the behaviors of your private equity firm changing, where they're going to say, okay, where's the payback of that investment? Are we seeing the ROI for that investment? Because while they have a 10-year fund, they really want that return a little bit faster. They want it in 3 to 5 years because they can then redeploy that capital into a new investment. And so you'll start to see there are dynamics around fund life that actually become interesting. As soon as you start to hit 3 years, 4 years, 5 years, the shift of grow turns into, okay, are we really optimizing the business? Are we really scaling efficiently? And so there's certainly phases of investments as well.
Oh my God, we could totally do a 1-hour webinar on this.
Yeah, totally.
But what stages do PEs invest in? What kind of opportunities also exist in the PE world? So, because our eWOW audience has 2 categories, if you will. There are startups who are interested in the PE world and PE investment. And then there are professionals who are interested in working for PEs, even though they might not come from a financial background. And we would love to know from you first in terms of what stages do PEs invest in, And second, in terms of what are the opportunities that exist?
Excellent. Great questions. Well, let me start with first the different phases, because first you have what is the seed phase, which is usually I have an idea that I want to fund to actually bring it to reality. So this phase is usually pre-product or service development, and it's usually pre-revenue. So as you would imagine, it's pretty risky. So the seed phases are typically smaller in size, maybe $500,000, $1 million to help fund the development of what usually seems to be like, ooh, this is an innovative idea. Mm-hmm. And once you actually get that product built, then you typically are moving into what is typically called your Series A phase, which is when, again, that product or service is built, but you need to actually build a market for it. So you need to scale a team, and you need to start building things like sales and marketing. So sometimes this is still pre-revenue or really early phases in revenue. So your typical size business for Series A is probably less than $3 million of revenue at this point, but it could still be zero. But once you actually now have a product and you've established a market, then you're typically looking at your Series B phase. So this is actually when you really need to figure out how to scale that business, going, okay, there's a market out here, but is my pricing right? And who really is my ideal customer profile? And who's my competition and what are they doing? So this is the phase where you start to realize you might need different people that have different experience, that have been through these phases before, or you might need to expand processes to really actually think about the efficiency and ROI in your spend. And you might need new systems, because a lot of times you're kind of like, I can do everything in Microsoft Excel, it's fine. And then you realize, okay, no, there are systems that can help me scale better. So businesses in this phase are usually in that maybe $3 to $10 million in revenue. So this is really about getting yourself the people, the process, and the infrastructure around you to start helping scale the business. So then Series C is really when you're really ready to focus on growth. And so this is typically when you're thinking, you know what? Maybe I want to build a new product and I want to fund building a new product because I don't want to be a one-trick pony. Or maybe you want to expand in a new vertical because maybe you started with attorneys, very similar to Ruby, and now you want to move into the medical segment or a different or adjacent segment, or maybe expand into a new geography. So you want a little bit of extra capital to say, can I go a little bit faster here? But you don't necessarily want to take every dollar out of your pocket to do it as the founder. So this is also the phase where you might start to consider M&A. But again, this is also a phase where the businesses here are probably $10 to $25 million of revenue, where you might be rethinking people, processes, and systems once again. There's kind of these growth phases where all of a sudden you're going, ooh, the people that got me to 10 million might not be able to be the folks that get me to 50 million. And I really need to think outside.
This is important to understand because the scale strategy at each phase is different. How you're going to scale is going to be different in each of these phases.
Exactly. And so here's, and to the folks out there in your audience that haven't actually really been in a private equity world, but they've worked for a scaled business and they're experts at process and system and data and efficiency, they're perfect for Series B, Series C companies, and even those later stage companies, even if they haven't worked in private equity before, because the reality is the entrepreneur very often has the idea, but they don't have that intersection of experience. And it's the combination of those two that are just brilliant, that really drive that accelerated growth and that really create that enterprise value.
So this is a perfect segue to my next question, which is, early on when I started my career, I remember when I came to US in 2005, I'm dating myself when I say that, but when I looked at the PE opportunities, I was always told that it's a very tight world. You have to come from investment background to find your way, and you have to be, you have to know all about the financial aspects of things, and which I, over a period of time, realized that is not true. How does one figure out what's the best way to approach the private equity firms for opportunities that you told about the latter half of our audience, which is professionals who have those skill sets that are required to enter into the private equity world?
Yes. So, well, I'll give you a little bit of the background of that compression that I know you felt, and I know I felt it as well, not being traditionally trained for private equity. Because the reality is there's a lot of technical training to get into private equity and to be successful in private equity. So you typically, the normal path is you go to college, you get a degree in finance, and you specialize in basically investment banking or private equity investing. And most universities now have programs that focus on these specific skills and needs, and the programs are high in demand. And so that's what makes it very competitive at the entry point. And of course, there are certifications. You have to be FINRA certified in order to operate in either the banking or the private equity segment. So the most common path is you go to university, you get the technical training, you get an internship while you're still at school, then you enter a bank or a fund after graduation at the entry level. And there's a pretty set path for how you develop. So you start as an analyst and you'll be an analyst for 3+ years. And then you move to an associate and you'll be an associate for 3 to 5 years. Then a vice president, then a director, then a managing director. But there are a couple of other adjacent paths to get in there. One of those adjacent paths is actually what I'll call adjacent markets. So maybe you got a degree in finance, but it wasn't in investment banking or private equity. So maybe it was financial advisory, or like me, you got a degree as a CPA. And so you're doing valuation work, you're doing fairness opinions. So you're seeing lots of different businesses, you're building that pattern recognition. Or you're doing transaction-related services, such as I'm doing quality of earnings reviews and things like that. Or perhaps even capital markets, you're doing debt and lending into private equity backed markets. So that's kind of another adjacent path. But then there is this third path, which is an operational path, which while I graduated with a CPA, I really took the operational path. And really what this requires is you need to just become an expert in an industry. So for me, that was technology. And firms value that industry knowledge because it actually helps them select investments better. It actually helps them to identify problems, or more importantly, opportunities faster. But you still have to learn the technical skills. So as an example, I went and got the training to supplement my operating skills. And it wasn't easy. It took lots of personal time to invest in those incremental skills, but that's exactly it. They were skills where you can't really train experience on an industry. So this is a really interesting path. And so what I would suggest, if you think about it, is it's easier to train the skills than it is to bring the experience. But once you have both, you almost become invaluable, because now you actually have both sides of the coin that actually work very successfully inside of a private equity firm. Now, most folks in a private equity firm will get their industry experience by focusing on an industry and saying, I'm going to become an expert in HR technology, and the only thing I'm going to do is read about HR technology. But if you've run, like you or she, multiple HR technology companies, that experience, that in the trenches experience, is invaluable. So the best way to really get into those private equity firms is to actually get in and show your experience. So very often you can just communicate with a private equity firm and saying, "Ooh, my experience is HR technology. Here are the 12 firms that really focus on HR technology. I'm going to reach out and explain to them how I can deliver more value by bringing my industry knowledge and expertise." In the meantime, there are additional skills in terms of valuation skills and things like that, and transaction-related skills that you can build up in the background. So that's a really interesting, for a seasoned person that's been an operating executive, a way to get into private equity.
And Kate, here you subtly mention it, but I want to highlight it once again. Be it the PE world or anything in your career, you have to continuously invest in yourself. You have to continue building your skills, because Unless you do that, you would very quickly be obsolete in this ever-changing world of the corporate landscape. You cannot be successful if you don't invest in yourself.
Absolutely. And this is where I'll go back and say, I never was looking to be a banker. I'm now an operating advisor of a private equity fund. Never thought I would do that. Never thought I'd be a CEO. For me, my passion was learning. And I also had a curiosity and a passion for technology. So I tried to build a career where I was doing the thing that I loved, which was technology, but doing it in a way where I felt like I was constantly learning. And for me, that was the path that has allowed me to navigate through a bunch of really interesting careers without having to say, I'm going to do X when I grow up, and really having a singular path.
Your journey is so exciting, Kate. I almost never get tired of hearing about it.
Thank
and
you.
Every time I do, I learn something new.
Oh, thank you, Rashim.
It was such a pleasure to have you on the podcast today. Thank you so much for sharing your insights with the eWOW audience. I will, of course, continue learning from you. That learning is never going to end.
Well, and I'm learning from you every day as well. So it's relationships like this that I encourage everyone to find them and form them.
And today's resource for you, my dear audience, is the link to the eWOW website where you can access all our upcoming events and resources. The link is in the show notes. As always, thank you for joining me today, and thank you for loving, liking, supporting, and sharing the podcast. Remember, sharing is caring. I look forward to seeing you again in our next podcast. Till then, keep empowering the world.